The institution has a name that almost every person on Earth has heard. It appears in newspaper headlines during currency crises and debt restructurings. It issues press releases about poverty reduction and economic stability. It sends delegations to the finance ministries of countries in distress. It arrives with a briefcase full of conditions and a line of credit attached to terms that the borrowing government has almost no power to negotiate. It is called the International Monetary Fund, and its official history describes it as an institution born from the wreckage of the Second World War, designed by visionary economists who understood that the competitive devaluations and trade barriers of the 1930s had helped turn a financial crash into a decade-long catastrophe. That is the account most economic histories preserve. The IMF, in that telling, is a cooperative institution owned by its member governments, governed by a charter written at a resort hotel in New Hampshire in the summer of 1944, and dedicated to the proposition that no country should be left to face a balance of payments crisis alone. The financial record tells a different story. Not a story of cooperative design, but of contested architecture. Not a story of rescue, but of structural reorientation. When the fund arrives with its credit line and its conditions, the question the standard account does not ask is simple and specific. Who is it actually protecting, and who is paying for that protection? If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. To understand what the IMF was actually built to do, it is necessary to go back further than Bretton Woods. The institution's design was not invented in 1944. It was assembled from arguments that had circulated in central banking and treasury circles since at least the early 1930s, and those arguments were shaped by a specific set of institutional interests that had nothing to do with the welfare of sovereign borrowers. The crash of 1929 and the banking collapses that followed had exposed something that most official accounts preferred to frame as a failure of policy rather than a failure of architecture. The international financial system of the 1920s was not a neutral mechanism. It was a set of interlocking obligations built on short-term lending by private banks in New York and London to sovereign governments and central banks across Europe, Latin America, and parts of Asia. The banks in question were not peripheral institutions. They were the largest commercial and investment banks operating in the world's two dominant financial centers, and they had, over the course of the 1920s, extended a volume of cross-border lending that bore no defensible relationship to the underlying productive capacity of the borrowing economies. When asset prices collapsed and credit contracted in the early 1930s, those short-term loans could not be rolled over. Governments that had borrowed in dollars or sterling to stabilize their currencies or finance post-war reconstruction found themselves unable to meet their obligations. The banks that had made those loans faced losses they could not absorb without destroying the depositor confidence that kept them solvent. The mechanism that eventually emerged to manage this problem, refined across 2 decades of institutional design, was constructed to ensure that those losses would not fall on the banks. The question the institutional architects were solving was not how to protect sovereign borrowers from capital market volatility, it was how to protect capital market creditors from the consequences of their own lending decisions, using the policy adjustment capacity of sovereign governments as the buffer. The Bank for International Settlements, established in Basel in 1930, was the first formal institutional expression of this principle. Its founding purpose, stated in its charter, was to facilitate the settlement of reparations payments owed by Germany under the Young Plan. That was the official account. The deeper history is more precise. The BIS was created at the initiative of central bank governors and private banking interests in New York, London, and Paris, who understood that the reparations mechanism was not, in any practical sense, about collecting war debts from a defeated country. It was about recycling American private bank lending into German sovereign obligations that would then flow as scheduled interest payments back to the banks that had originated those loans. Owen Young, the American corporate lawyer and General Electric chairman whose name the plan carried, was simultaneously a director of the Federal Reserve Bank of New York and held professional relationships with the Morgan banking network that stretched back to the 1910s. The Young Plan's financial architecture was not designed by disinterested economists working from first principles. It was designed by men who occupied positions simultaneously in private banking and in the public institutions nominally responsible for regulating that sector, and who had a direct financial interest in the structure they were creating. The BIS was the institutional vehicle they built to manage what the reparations mechanism actually was, a cross-border capital transfer system in which sovereign governments were the nominal parties to the transaction, and private banks collected the economic benefit. When the reparations system collapsed in 1931 and Germany suspended payments under the Hoover moratorium, the BIS did not dissolve. It restructured, absorbing its surviving clearing and settlement functions into a more durable institutional form, and preserving the network of central bank relationships that would prove indispensable to the design negotiations at Bretton Woods. The officials who had shaped the BIS's operating procedures in the 1930s were, in several cases, the direct institutional predecessors of those who advised the governments negotiating the fund's charter in 1944. The correspondence preserved in the archives of the Bank of England and the Federal Reserve Bank of New York documents a continuity of purpose across the interwar period, an ongoing effort by the major creditor country central banks to construct an international financial mechanism that would protect cross-border claims of private creditors while distributing the costs of adjustment to sovereign borrowers and, through those borrowers, to their domestic populations. The conference at Bretton Woods in July of 1944 is remembered primarily as a competition between two competing visions. On one side stood John Maynard Keynes, representing the British Treasury, advancing a proposal for an international clearing union with symmetric adjustment obligations. In Keynes's design, surplus countries running persistent trade and current account surpluses would face the same institutional pressure to adjust as the deficit countries whose imbalances their surpluses were generating. The mechanism Keynes proposed was a notional currency called the bancor, held in accounts at the clearing union, with financial charges applied to both excessive deficit and excessive surplus positions. The design recognized that a surplus in one country was by arithmetic necessity a deficit somewhere else, and that a system placing all adjustment pressure on the deficit side would permanently tilt the global economy toward the preferences of creditor nations at the expense of debtor nations. On the other side stood Harry Dexter White, representing the United States Treasury, advancing a more limited proposal with a smaller lending facility, heavier conditionality on assistance, and an explicit insistence that adjustment burdens fall on deficit countries rather than on surplus creditors. White's version prevailed. The United States held approximately 70% of the world's monetary gold at the war's end, and the dollar was the only currency with the institutional credibility to anchor a new international system. What the United States wanted from the institutional design, it received. The scarce currency clause inserted into the Articles of Agreement was the only formal concession to Keynes's argument about surplus country responsibility, and it was a concession that everyone in the negotiating room understood would never be used, because using it would require a supermajority vote that the United States could block. Within White's design, the structural choices that most directly shaped what the institution would actually do in practice concerned the adjustment mechanism and the governance structure. On adjustment, the Articles of Agreement placed the responsibility for correcting balance of payments deficits squarely on the deficit country. A country drawing on the fund would be required to demonstrate that it was taking measures to address the underlying causes of its deficit, and the fund's executive board would assess those measures and attach conditions to the disbursement of each tranche of the credit line. The mechanism did not require creditor countries to take any corresponding action to reduce their surpluses. On governance, the voting structure based on quota subscriptions produced a governing majority that reflected the interests of the countries that were the institution's likely creditors rather than the countries that would be its likely borrowers. The United States held a blocking minority from the institution's first day of operation. The Western European industrial nations combined with the United States to constitute an effective controlling majority. The developing countries that would become the primary borrowers from the fund in the decades after the Bretton Woods system's collapse held voting shares that bore no relationship to their combined population, their aggregate economic output, or their collective stake in the institution's decisions. That governance structure has been reviewed and partially adjusted in several rounds of quota reform since the institution's founding. The United States still holds a blocking minority. The Western industrial nations still constitute an effective governing majority on the decisions that matter most to sovereign borrowers in the developing world. The fund began operations in 1945 with 44 member governments and a mandate to oversee the fixed exchange rate system the conference had established. For its first 2 decades, the institution operated primarily as a monitor of exchange rate policy and a provider of short-term balance of payments support to industrial countries experiencing temporary external financing difficulties. United Kingdom, France, and several other Western European governments drew on the fund during the 1950s and 1960s as their post-war reconstruction costs and the obligations of managing declining imperial positions put persistent pressure on their currencies. The conditions attached to those drawings were real and sometimes politically painful, but the borrowing governments retained sufficient diplomatic and strategic weight to preserve meaningful domestic policy autonomy. The fund in this period operated broadly as its charter intended, as a short-term liquidity facility for countries facing temporary balance of payments difficulties within a system of fixed exchange rates. The institutional purpose the fund was designed to serve ended in August of 1971, when President Nixon announced the suspension of the dollar's convertibility into gold and effectively dissolved the Bretton Woods system. Major currencies moved to floating exchange rates over the following 2 years, and the fund's mandate to oversee fixed parities became formally irrelevant. The institution faced an existential question. What was it for, now that the system it had been built to manage no longer existed? The answer the major creditor governments and the fund's own senior management arrived at was expansion into a new role, one for which the Articles of Agreement provided only indirect authority: the management of sovereign debt crises in the developing world. The transition into this role was created by a specific financial development of the 1970s. The oil price increases of 1973 and 1979 transferred enormous current account surpluses to the petroleum exporting countries, most of which lacked domestic financial markets capable of absorbing those surpluses productively. The surplus funds were deposited in the major commercial banks of New York and London, which faced the institutional problem of placing a large volume of new deposits in a global economy where demand from creditworthy industrial borrowers was weak and domestic lending margins were compressed. The solution the banks identified was sovereign lending to developing countries, which offered higher interest margins than comparable industrial country lending and carried the implicit assumption that sovereign governments backed by their power of taxation could not go bankrupt in the way private corporations could. The reasoning was captured in the phrase attributed to Walter Wriston, then chairman of Citicorp, that countries don't go bust. Between 1974 and 1982, the major American and European commercial banks extended several $100 billion in loans to sovereign borrowers across Latin America, sub-Saharan Africa, and parts of Asia. The loans were denominated in dollars, structured at floating interest rates referenced to the London Interbank Offered Rate, and sized on assumptions that the global economic conditions of the late 1970s would persist indefinitely. Those assumptions collapsed in October of 1979, when the Federal Reserve, under Paul Volcker, sharply increased American interest rates to break the inflationary pressure that had accumulated through the decade. Dollar interest rates rose from roughly 10% in 1979 to over 20% by mid-1981. Commodity prices fell simultaneously as demand contracted across the industrial economies. The countries that had borrowed at floating dollar rates now faced an arithmetic that could not be managed through domestic adjustment alone. The annual interest cost of their external debt had roughly doubled at exactly the moment their export revenues were falling. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. In August of 1982, the Mexican finance minister, Jesus Silva Herzog, contacted the United States Treasury and the Federal Reserve to inform them that Mexico could not meet its scheduled debt service obligations falling due within days. Mexico's external debt at that point stood at approximately $80 billion, owed primarily to American and European commercial banks. The 9 largest American commercial banks held loans to Mexico, Brazil, and Argentina alone that amounted to more than 260% of their combined Tier 1 capital. That figure carried a precise institutional meaning. If those 3 countries simultaneously ceased paying interest on their debts, the largest banks in the United States were insolvent. The Federal Reserve and the Treasury understood the stakes within hours of Silva Herzog's call. What followed over the next 72 hours was not an IMF-led deliberation about the best path to restoring Mexico's long-term economic health. It was a crisis management operation conducted from the conference rooms of the Federal Reserve Bank of New York, with the fund brought in as the institutional mechanism through which the private sector rescue would be delivered and its costs distributed to parties other than the banks that had originated the loans. The conditions the IMF attached to Mexico's emergency program included reduction of the fiscal deficit by several percentage points of GDP within a single year, wage restraint in the public sector, removal of consumer subsidies on energy and food, and the acceleration of trade liberalization. None of those conditions were designed primarily to address the structural weaknesses in Mexico's development model or to restore the conditions for long-term economic growth. They were designed to generate a current account surplus sufficient to allow Mexico to continue making full interest payments on its external debt, while the commercial banks received no reduction in the principal or the contracted interest rate on their loan portfolios. Paul Volcker's memoir, published in 2004, describes the August 1982 negotiations with an honesty that the fund's own published accounts of the episode do not match. The priority, as Volcker describes it, was ensuring that the commercial banks did not face losses that would destabilize the American financial system. The IMF's conditionality program was the instrument through which that priority was operationalized, and the fund's resources were the bridge financing that allowed Mexico to keep the payments flowing to the banks while the adjustment program was implemented. The same structural logic repeated itself across Latin America through the years that followed. Brazil, Argentina, Chile, Bolivia, Peru, Uruguay, Nigeria, Zambia, and the Philippines all entered into IMF adjustment programs during the 1980s, carrying conditions essentially identical to Mexico's. All experienced significant declines in real wages and public investment during the adjustment period. All continued to service their external debts to the commercial banks throughout. By the end of the decade, the net transfer of financial resources from the heavily indebted developing countries to their creditors, meaning the excess of debt service payments made over new lending received, exceeded in aggregate a figure that several economists at the time compared directly to the Marshall Plan, noting that the direction of the transfer was precisely opposite. The Economic Commission for Latin America and the Caribbean documented the transfer flows annually through the decade in published reports that drew on IMF, World Bank, and national government data. The decade is now referred to in the development economics literature as the lost decade for Latin American development. Per capita income across the region in 1990 was lower in real terms than it had been in 1980. Infant mortality rose in several countries during the adjustment period. Public health and education expenditures contracted sharply. The fund's own internal evaluation department, in a series of reports produced through the 1990s, acknowledged that the programs of the previous decade had underestimated the contractionary effects of simultaneous fiscal adjustment across multiple major developing economies, overestimated the speed with which trade liberalization would generate export revenues sufficient to service external debts and restore growth, and paid inadequate attention to the social and distributional consequences of the conditions being required. Those acknowledgments appeared in specialist publications read by development economists and IMF technical staff. They did not alter the institutional design of the conditionality framework that had produced the outcomes being evaluated. The Asian financial crisis of 1997 brought the institutional design into its sharpest public focus in the post-Cold War period. When speculative pressure on the Thai baht triggered currency contagion across Indonesia, South Korea, the Philippines, and Malaysia during the second half of the year, the affected economies had not borrowed recklessly in the manner of the Latin American governments of the previous decade. Their public fiscal positions were largely sound. Their sovereign debt ratios were manageable. The crisis was driven by the rapid reversal of short-term private capital inflows from foreign portfolio investors, hedge funds, and international bank lenders, who had placed large sums into the region's equity and bond markets during the expansion years, and withdrew with equal speed when regional currency pressure began. The underlying vulnerabilities were real: weak domestic banking systems, inadequate financial regulation, and current account deficits in several countries financed by short-term capital flows. But the speed and severity of the currency collapses reflected the behavior of the external private creditors as much as any domestic policy failure. The IMF's emergency programs for Thailand, Indonesia, and South Korea attached conditions requiring sharp fiscal contraction, high domestic interest rates to defend the exchange rate, restructuring of the banking system on terms favorable to foreign acquisition, and accelerated opening of previously protected domestic industries to foreign ownership. Joseph Stiglitz, serving as chief economist of the World Bank during the crisis and therefore present in the deliberations that shaped the institutional response, wrote and spoke publicly about the mismatch between the crisis's actual causes and the conditions the fund was requiring. His account, developed at length in his book published in 2002, named the institutional pressure from the United States Treasury and identified the interests of foreign creditors and institutional investors seeking to acquire distressed regional assets as operative constraints on the design of the fund's programs. Stiglitz was asked to leave his position at the World Bank in 1999 in circumstances that were widely reported at the time and that he described in subsequent interviews as directly connected to his public criticism of the fund's crisis management. His published account is the clearest named institutional admission in the accessible record, produced by a credentialed economist who was present at the relevant deliberations and who subsequently used the full resources of academic publication to document what he had witnessed. It was not suppressed, it was published openly. It received wide coverage within the development economics and policy communities. It did not produce any institutional revision of the conditionality framework whose design Stiglitz had documented. What the ledger shows, when placed beside the official account with precision rather than inference, is an institution whose operational design has remained consistent across 8 decades, not because that design has succeeded in its stated purpose, but because it has succeeded in a different one. The architects of Bretton Woods, working from the institutional experience accumulated through the interwar period by the central banks and private banking networks that had shaped the Young Plan and the BIS, constructed an institution whose governance gave creditor countries effective control over decisions affecting debtor countries, whose adjustment mechanism placed the full cost of balance of payments correction on the deficit side, and whose conditionality framework aligned borrowing country economic policy with the continuing service requirements of the private creditors whose claims the fund's resources were deployed to protect. The institution has been formally reviewed, internally evaluated, and publicly criticized across its entire history. The voting structure that concentrates governance power in the creditor country bloc has been modestly adjusted in several quota reviews without being fundamentally altered. The conditionality framework has been publicly revised on several occasions, with the IMF issuing guidelines in 2002 and again in 2012 that nominally reduced the number and intrusiveness of conditions attached to programs, while preserving the core fiscal and financial sector requirements that had always constituted the substantive heart of the adjustment design. The scarce currency clause that was supposed to impose symmetric pressure on surplus countries has still never been invoked. The institution that arrived in Mexico City in August of 1982 to manage a sovereign debt crisis still operates on the same structural principle, that the obligations of borrowing governments to their external creditors are senior to their obligations to their own populations, and that the fund's assistance is conditional on the borrowing government's demonstrated willingness to enforce that priority in its fiscal, monetary, and trade policy choices. The official account describes an institution built to protect countries facing balance of payments difficulties. The financial record describes an institution built to protect the private claims held against those countries, using the sovereign authority and the policy adjustment capacity of borrowing governments as the instrument, and their populations as the ultimate bearer of the adjustment cost. The gap between those two accounts has been visible since the first day of the Bretton Woods negotiations in 1944, and it has been confirmed in operational practice by every sovereign debt crisis the institution has managed in the 8 decades since. It is not a gap that requires inference or reconstruction. The record states it directly, to any reader willing to place the financial architecture of the programs beside the stated objectives of the institution, and measure the distance between them. The consequence of that gap is not abstract. It can be measured in the public health budgets of countries that spent the 1980s transferring more capital to foreign bank creditors than they received in new lending. It can be measured in the wage data of workers who bore the cost of fiscal adjustments that the institutions designing those adjustments were structurally insulated from. It can be measured in the sovereign debt contracts that governments signed under conditions that left them no meaningful alternative, with creditor country voting blocs on the fund's executive board approving programs whose design reflected the interests of those same creditor countries in an arrangement that no one at the table was required to acknowledge as a conflict. The financial architecture constructed at Bretton Woods did not require malice to produce these outcomes. It required only that the men who designed it were the same men who had the most to gain from the protection it provided, and that the institution they created was governed by the countries whose banks held the claims the institution's programs were structured to protect. That alignment of design with interest was not hidden. It was embedded in the voting weights, the adjustment obligations, and the conditionality framework from the first day the institution opened. The Greek debt crisis of 2010 provides the most recent and most documented instance of the same structural principle operating in a different geography. When Greece faced a fiscal collapse and lost access to bond markets in the spring of that year, the rescue package assembled by the European Commission, the European Central Bank, and the IMF, the arrangement that came to be called the Troika, attached conditions requiring deep reductions in public sector wages, pension cuts, and tax increases, all to be implemented simultaneously. The explicit stated objective was to restore market confidence in Greece's ability to service its debt. The debt in question was held primarily by French and German banks that had extended credit to the Greek government through the previous decade at interest rates that reflected the assumption that membership in the Eurozone had eliminated meaningful default risk. When that assumption proved wrong, the Troika's program transferred the cost of the correction to Greek pensioners, public sector workers, and the unemployed, while the French and German bank creditors were made whole on their principal through the first 2 years of the program. The IMF's own post-program evaluation, published in 2013, concluded that the initial rescue had prioritized the protection of bank creditors over the restoration of Greek economic growth, that the fiscal adjustment required was larger and faster than the economy could absorb without severe contraction, and that the debt restructuring which eventually occurred in 2012 should have been implemented 2 years earlier. The report named the institutional pressure from European creditor governments as a constraint on the design of the original program. It was published as a working paper. It did not change the institutional design of the conditionality framework for subsequent programs. The fund that designed the Greek program in 2010 is the same institution that designed the Mexican program in 1982. The specific creditor interests being protected were different. The structural principle protecting them was identical, and the institution carrying out that protection was governed, in both cases, by a voting structure in which the countries whose banks held the claims at risk held an effective majority of the votes, determining the terms on which the rescue would be delivered. The broader question the standard account was never designed to answer concerns what happens to a borrowing country after the program ends. The credit lines are repaid. The technical delegations depart. The finance ministry returns to borrowing from the same private creditors whose claims the program was designed to protect, now under a restructured debt profile that the conditionality framework was supposed to make sustainable. Whether that sustainability materializes depends entirely on whether the economic assumptions embedded in the program design prove accurate. In the case of the 1980s debt crisis, those assumptions did not prove accurate for most of the affected countries. The export revenue growth the programs projected did not materialize at the speed the conditionality frameworks required. The investment contraction produced by simultaneous fiscal adjustment proved deeper and more persistent than the fund's economists had modeled. The social costs of wage restraint and subsidy removal accumulated through years of implementation, producing political instability in several countries that required additional programs and additional rounds of adjustment imposed on populations who had already absorbed the first round without the growth that had been promised as the return on that adjustment. Argentina's experience across the 1990s illustrates the pattern with a precision that requires no reconstruction. The country entered a series of IMF programs beginning in the early years of the decade under conditions requiring fiscal consolidation and the maintenance of a fixed exchange rate linking the peso to the dollar at parity. The peg was presented as the anchor of Argentina's macroeconomic stabilization. It was also a mechanism that made Argentine exports progressively less competitive as the dollar appreciated through the late 1990s and transferred the full burden of adjustment to domestic wages and employment when external conditions deteriorated. By December of 2001, the adjustment the peg required had become politically impossible to sustain. Argentina defaulted on approximately $100 billion of external debt and abandoned the exchange rate peg in January of 2002. The peso lost more than two-thirds of its dollar value within months. Unemployment exceeded 20%. The IMF's own review documents, published in 2004, acknowledged that the sustainability of the peg had been assessed on assumptions about external financing conditions that the fund's projections did not adequately stress test, and that the programs of the late 1990s had continued to disperse tranches to a government whose debt dynamics were already deteriorating beyond the range the programs had been designed to address. Those reviews exist in the published record. The institutional design they evaluated continued to operate on the same structural principles through the programs that followed. The thread running from the Young Plan of 1929 through the Bretton Woods negotiations of 1944 to the Mexican crisis of 1982 and the Greek program of 2010 is documented in the institutional archives of the organizations that designed the mechanisms, in the published memoirs of the officials who operated them, in the self-evaluations the institutions themselves produced when the gap between their stated objectives and their actual outcomes became too large to leave unaddressed in specialist literature. The gap has been acknowledged, evaluated, and published. The mechanism that produced it has continued to operate. A system that produces the same distributional outcome across 8 decades of institutional operation, while generating internal evaluations that acknowledge the mismatch between program design and stated objectives, is not a system that has failed to achieve its purpose. It is a system that has achieved a purpose other than the one stated at its founding. The institution's official name describes a fund for member countries. The financial record describes a fund whose design and governance have consistently prioritized the claims of creditor country financial institutions over the welfare of borrowing country populations. Both descriptions are accurate. They describe the same institution from positions on opposite sides of the ledger. For the populations who absorbed the adjustment costs of the programs the fund administered, the ledger was never abstract. It was the wage that did not increase, the pension that was reduced, the hospital ward that closed when the capital budget was cut to meet the fiscal targets the executive board had approved. The record of what those programs produced sits in the same archives as the program documents that authorized the adjustment. No one sealed it. No one classified it. It is available to any reader willing to place both sides of the account beside each other and read what the full ledger contains. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.